I'm Matt Bishar with NAREIT, here in Hollywood, Florida for NAREIT's REITwise, the 2018 Law, Accounting, and Finance Conference. Joining me today is Daniel LeBey, partner capital markets and M&A with Vinson & Elkins. Daniel, thanks so much for joining us.
Thanks for having me.
Now, can you start by talking about your outlook for the REIT IPO markets? How much activity do you currently see in the pipeline, and what types of deals would you expect to get completed?
The REIT IPO market's been pretty slow, as you're probably aware. The REIT capital markets generally have been slow. I think that's mostly due to the interest rate environment that we're in. We've been through this cycle before, and history shows that this doesn't last forever. Usually 4 to 6 months after the sort of the kind of volatility in the interest rate sector stabilizes, you start seeing quite a bit of capital raising again. So I actually feel decent about the outlook for the latter part of 2018. In terms of the types of IPOs that we're seeing, we do have a few in our pipeline that are sort of waiting for the window to open. And I know others in the industry do as well. Lawyers at other firms that I talk with and some of the bankers that we speak with have said the same thing. So there's some pent-up demand, but I think it's going to be challenging to get IPOs done in the REIT space, even when things stabilize, unless certain conditions are satisfied. Generally, something new. New asset classes. We've got one that we're involved with now where we would be on the underwriter side, but that I think is very interesting because it's a new asset class that doesn't really exist in the public REIT space now. And also some of the traditional asset classes where there's a new strategy. There's a lot of things happening in the commercial real estate space, and the commercial real estate industry is strong. The economy is strong. There are certain sectors within that space, even the traditional asset classes, that have performed reasonably well on a relative basis. Industrial properties, for example, there's not enough. There's more demand for industrial space than can be developed right now. Just from Amazon alone, it seems. And I think other traditional asset classes like self-storage and even hospitality, where they can sort of turn over their rental rates, if you will, because they're short-term to adapt to growing demand. And you're also seeing interesting things happening within other traditional asset sectors like office, the whole sort of co-working sort of trend within the office space, kind of repositioning traditional asset classes in a different way. So I think the management teams that are smart and that can kind of come up with a new strategy to capitalize on those trends could see some could tap the IPO market. Now,
another one of the traditional sectors, the mall sector, we're starting to see some M&A activity there. Do you expect more deals like the Unibail Westfield? And outside of malls, are there any other sectors where we might see more M&A?
Yeah, so as you know, the retail sector has been under some pressure, sort of the online retailing pressure that has sort of ramped up over the last 10, 15 years has really kind of created a lot of downward pressure on the traditional kind of brick and mortar retail model, with some exceptions. But so there are a lot of retail assets that have to be sort of repositioned, and I think whenever you have distress in any industry or in any sector, you see some consolidation. So I wouldn't be surprised to see some other mergers in that space. I wouldn't be surprised to see other mergers in the REIT industry generally sort of ramping up this year, just because of the fact that the REIT sector is down in terms of stock prices. While like I said, I think it'll come back in the latter part of the year, I hope. I mean, don't have a crystal ball, obviously, but whenever stock prices are down in a particular industry sector, consolidation is usually what happens. And we're seeing some of that. We've been involved with a few M&A deals already just in the last 6 months. We have one active deal in process now, and there's a couple of other that are sort of in the early stages. And if the sector doesn't come roaring back in the latter part of the year, I wouldn't be surprised if we didn't see more M&A activity, not just in the retail space, but maybe in some of the other traditional asset sectors as well.
And lastly, how will the bill to reinstate FHLB captive membership impact REITs?
Well, the Senate bill that exists now, if it makes its way through Congress and ultimately becomes law, I don't think it's going to be that significant. But first of all, it's a limited universe of companies that can take advantage of that. We've got a bunch of the residential mortgage REITs that form captives that got their FHLB membership before the moratorium came on. I guess it was January 2016. Anybody who had a captive that was a member before that actually, under the Senate bill, could get reinstated if it becomes law. But that's It's a relatively narrow segment within the broader REIT space. But for the ones that have it and can satisfy the conditions, it does give them an advantage. I mean, they basically just get access to better financing terms through the FHLB membership for their captives. So, good for them.
Great. Well, Daniel, thank you so much for joining us.
Thank you.
For more from REITwise, be sure to visit NAREIT's website, REIT.com.